All right, all right. There we are. There's our close for today. It's 32.31, I think, is the print. So interesting to see. Yeah, how about that? So it's another almost 6,000 contracts at 32. They're decently in the money. 32 and a halves are not. 33s are not. Interesting. Very interesting. Yeah, how about that day? Interesting trading day. One thing I want to take a look at. Actually, I want to see this. This is what I wanted. Welcome everybody. Before we get into some of the things I want to look at today, welcome to Friday evening streams here. Welcome to Office Hours. Good to see you all. Hope you had a good trading week. This unexpectedly short trading week. Definitely some stuff for us to think about a bit today. I definitely want to reflect a bit on our price action, reflect a bit on the week, and then I want to spend a little time going over some older DD that has to do with some of these principles that have to do with volatility and liquidity and how these were interrelated and have been interrelated for some time in influencing these highly upwardly mobile price action events in GameStop, how we might be looking at some of these types of events. We might have seen some of these earlier in the week. Talk through some of my perspectives on that. So a bit of this will run together. And then, I also want to think a bit more broadly about this recent reply, not quite a post on X, by Ryan Cohen, but why I think what I think this might mean in light of the maybe days and months to come, and what that might result in for Ryan Cohen, and maybe how this ties into a broader vision for the company. So yeah, definitely want to think about that, and then we'll have some time toward the end for questions and thinking about that. So yeah, so let me draw our attention first. Let's hop over to our chart for today. So yeah, a weird day in general. I mean, I came into this day. I made sure I put this into today's breakdown video and in today's write-up. Yeah, I was really like, where are we gonna go? This is a weird setup. Like technicals and RSI are not really lining up right. IV doing strange things. Especially look, and I know I mentioned this when I was recording the video. Sometimes we see kind of IV pop up after hours and then just kind of immediately come back down and then not really have an effect on the day. That's not what we saw. So in a period, like in an overnight period with no trading, right? We went from, let's see, after hours value, but even like kind of a closing value. We had this. What the heck was going on here? This little stepwise thing. This looked like, oh, maybe it was nothing, because then the prices kind of went back in with this trend. But okay. But then as soon as we closed, right, a little bit after we closed, we popped back up here to 119. Our real close there in terms of IV, right, was like 115%. And then we went into almost 120 in the after hours. And then after our day off, right, in pre-market, we were at over 135%. So why did we have this massive, more than 15%, almost 20 percentage point jump in IV? And then, yeah, that got assessed immediately in options prices off the open, right? So implied volatility is matched by it's tracked by the Greek letter vega. So, well, it's not a real Greek letter. The options Greek, it's a fake Greek letter that is a word that is used to correspond to IV that sounds like maybe it would be a Greek letter. In fact, most of the Greek letters are not actual Greek letters. There's like, what is it? Vanna is not, Vega is not, Volga is not. Those three are not real Greek letters. The other ones are. But the importance of implied volatility as Vega is that it factors in and of itself into the pricing of an option, and it also affects through the derivative value Vanna, also not a Greek letter, the delta of an option. So the implied volatility has an effect on the rate of change, or the degree to which an option's value increases or decreases based on a $1 move in the underlying. So it affects the delta. But what's really weird about IV and Vega is that it's set by brokers. Like it's not like it's, oh, okay, well, based on this price and based on this, it's like it's set by brokers based on the risks to their like position in the stock. Like if they're, I don't know, if broker dealers have like, I don't know, if they're like, oh no, this is going to jeopardize, like if the price today moves up this much, then that's going to be a problem for our, for our neutrality. That's going to be a problem for our market making strategy. That's going to be a problem for our options market making strategy. So we're going to just increase the value. We're just going to set the value of this variable higher to reflect our greater risk of exposure, right? And I think I've talked about this in the past. Brokers will do this in order to incentivize sales, right? So when you jack up IV, right, when you increase IV, this, on the one hand, this increases the prices of options contracts, right? So as IV goes up, as the implied volatility goes up, the prices will go up, especially on out of the money contracts, right? In the money contracts, actually, interestingly, as you increase implied volatility in the money contracts, right, the value of in the money contracts it depends, but you can decrease the delta on an in the money contract if the IV goes up, right? So this is why, for example, you can have like a $20 call. You can have a $20 call that expires in, a week, that is going to be affected hugely. It can be really affected by the implied volatility, whereas one that expires in a year is not going to be affected by the implied volatility very much. So something like, this isn't very good. Actually, I'll show you the delta here for the weeklies. So like, you can have it in the money, right? So a $20 here that expires next week has a delta of 1. So like, this is a fully delta hedged contract. It's a fully gamma hedged contract. For all open interest at this strike for next week, dealers are holding 100% of the shares necessary to deliver this contract. Like it is essentially a certainty. It is a statistical certainty, effectively, that this contract will finish in the money between now and then. The odds that it will go out of the money are minuscule, and so dealers are fully hedged for this contract. Right, the 21s and 20s right here. But if you go farther out, if you look at the Januaries here, the delta on the 20s is 85. So they're only 85% delta hedged on that position. So if we go back here, right? So as you increase volatility, this is what I want to look at. As you increase the implied volatility, you make, let's say, out of the money contracts that have low probabilities of closing in the money. If it's a week out, you increase the price, you increase the implied volatility, you'll increase the price of those, and that's going to incentivize volatility sales. That's going to incentivize short sales of calls. So likely what happened here, right, to avoid shorting, because it does look like XRT did remain on reg show. So that means there was decreased synthetic liquidity for GameStop, meaning a decrease in the ease at which shares can be acquired for shorting and settlement purposes, or for the settlement of failed to delivers, for the settling of shorts, for the closing of short positions, which puts short positions at risk if it is harder to acquire shares, right? If volatility is higher, it means that if you go to close your short position, it means you are at risk of causing, you are at risk of greater loss, or at risk of loss by closing that short position, due to the degree to which, when you cover that short position, you will cause a very significant price appreciation. So what seems to have occurred here early in the day was dealers jacked up the IV by 20%, and then this just instantly caused a large volume of IV sales, because, well, wait a second, those same contracts at close on Wednesday were way, like, they were way less expensive, right? Okay, now they're here. Oh man, like, if I was going to sell them on Wednesday, I'm definitely selling them more here, right? And then just sell this peak, and then they lowered it, I guess, once they got their drop, right? Then IV comes down, and then, okay, then they're fine, right? Then they get it here, and then they can hold the IV stable. But a lot of this, I think, was caused in part by incentivizing IV sales, but in part, I think, because by increasing IV like this, it may have allowed them to de-hedge their positions. So they were able to sell long shares as a result of that IV appreciation. Yeah. So this happened early, and then what I want to take a look at, this buying pattern here, which is interestingly confusing buying pattern. Right, this kind of diagonal line that we've seen before. This looks a lot like this. This looks a lot like a VWAP order, a very large VWAP order. So we'll talk about that in a sec. Yeah, good questions on the 125Ps. We can take a look at that later too. Yes, Roanoke. I would say this week did in fact feel like it lasted quite a while. Yeah, it just felt like just sitting around waiting for stuff to happen. I think that's, sort of that's what's going on back here. I somewhat suspect that part of the reason why dealers have been kind of fast and loose here with IV, why we have our IV level, is the fact that we're getting to these sort of squeeze-anniversary dates, right? We're getting close to these key dates from the 2021 event, and market makers, institutions, whoever's playing this right now, whoever has a hat to toss in the ring, or who's exposed dealer wise, who has control maybe over this IV, is probably justifiably worried that maybe something could spark some kind of a big reflexive interest in the stock again because of that. They have no idea that's a real risk, right? Like, meme stock mania, virality of something is a real risk. I don't know if the people who control IV are the same people that have control over the algorithms that pump the stock whenever Roaring Kitty drops a tweet. So sometimes I wonder if, like, this is like brokers like pricing in the potential of a Roaring Kitty tweet. At this point, I don't think it's necessarily unlikely. Yeah. So what we see here, this looks like a VWAP order. So this looks like the settling of a position. This looks like either the closing of a margin call. This looks like possibly buying to get a certain number of shares in order to meet settlement requirements. Maybe it's something tied into XRT still being on reg show. But one way that we can find out, right, is that usually these VWAP orders, you'll see them kind of chug like this, like a diagonal line. A good indicator is they're going to ride the 20-minute moving average, right? So if you see the price just sitting, like, it'll usually take off somewhere around VWAP. So if in your trading, right, you have VWAP here, the volume weighted average price. So these bands, which, throughout the day, 99% of the time, the price is going to stay, maybe 98, I don't know. The price is going to stay within, actually, wait, we can calculate this. 2 standard deviations above average is probably closer to 97% than it is 98%. But it's basically like the volume weighted average price. 97% of the time, the price is going to stay within the bounds of 2 standard deviations from the volume weighted average price. So there's a lot. I mean, I'm not necessarily telling you to go day trade. It's tricky. You need to have need to have an iterative strategy to make it work, and you need to be disciplined about sort of repeatable situations. But 98% of the time, 97% of the time, the price will stay within the standard deviations of the volume weighted average price. So that's what these lines are, right? This is 2 standard deviations above the volume weighted average price. This is 2 standard deviations below the volume weighted average price. And what you'll see is if you see it kind of start, you'll see it take off somewhere around VWAP, right? And then it'll just kind of ride the 20-minute moving average just in this diagonal line pattern, right? Trade up a little bit, trade down, and then trade up, and then just kind of do this all the way. And then it stopped, it finished here, right? So we got vertical up here. We started to really move off the line. So this is probably where it was coming to a close, right? Traders were starting to play with this a little bit up here, and then this is where it was probably completed somewhere in here. So another way we can check, yeah, this is good. Remember to ask this question. Actually, I'll come back to this question later, but that's a good question. Another way we can check is if we head over to Unusual Whales. For those of you that subscribe to Unusual Whales, usually this won't show up. This trade will show up as a dark pool trade, even though it is not. Let's see, where's our dark pool orders? So let me share this tab instead. Let me move me somewhere here. I'm just like, no, I can't do that. I can do this though. There we go. Okay, let's zoom in here a bit. So, okay, these are our lit whale orders. These are our lit whale orders. So if we go over to our dark pool feed here, filter by GameStop. Might not have it in here yet, but usually it comes through as an average price trade. Prior reference. Interesting. We don't have that yet. That is very peculiar. Yeah, the last few times I've seen something like this VWAP trade come in. It may be too early. 419. It might not show up until like 4:30, but it'll come in as like an average price trade. So that'll be interesting to check up on. See if I can see that. All right, let me get back here. So, yeah, I mean, a very interesting week here. I think I want, no, not this. I want this. Yes. So we had, right, if we go back, Monday and Tuesday definitely started out very, very intriguingly. Right, we had actually 3 days in a row. So if we go back to last Friday, right, we basically had 3 gamma ramp events 3 days in a row. So we had this, if we stretch it back, can we do 10 days? Yeah, we can do 10 days. Starting here, right? So we had a high amount of shorting in here, right? Kind of a bleed off, short, and then recovery, and then kind of flat, and then a little bit of sell off. This decent amount of selling. So this was the Unity day, right? So we opened up high and then sold off, right? So this pumped in the after hours or the overnight market. Sold off, recovered here on this gamma ramp dynamic. So basically whoever was short here decided, okay, let me actually do this. Whoever was short here decided, okay, right, so they'll short, leave the position open. And then while this is happening, likely, this is what I speculated, right, earlier in the week, likely, while this is bleeding out, right, you see IV goes down with it here. Actually, let me move my thing out of the way. So, right, you see price go down, and as this is being shorted, IV is going down with it. So as IV is going down, right, especially out of the money calls are getting less expensive, especially for weeklies that don't have very much time left, right? They're going to take a huge hit if the price is moving down and volatility is going down. They're going to take a huge hit. So we can actually go check this out, right? So if we go to let's say this week's weeklies, we don't have the chart for the ones for the 3rd of January anymore, but let's take 35s, right? So something out of the money. Always usually a high volume at this one. Right, so these will bleed. We're at, let's see, 1, 2, 3, 4, 5. Yeah, okay. So here's Monday. These ones, yeah, I think a little too far out. These weren't as much affected, but you do see a step up here, right? So these went up, right? You can sell these here. You understand this effect, right? You can sell these here, short. You can purchase them, maybe cheap, something like that. This is, let's see, where is this? Yeah, this is Monday, right? Similar thing going into Monday, especially with the weeklies. You have to do it with weeklies. It's a shame we can't see what the ones from January 3rd looked like. But if you were to take a look at the ones from Monday, right? Similar principle. You can short the stock. So these lose value, right? They're continuing on this downward trend. They're continuing towards expiring worthless, which, oh, by the way, they did anyway. You can buy them down here, right? These got down. These are cheap, 20-something cents. These are below 30 cents, like 25 cents here. All through this period, you can slowly acquire these. We can see that the volume was pretty good, right? So volume, we've got almost 3,000 contracts traded here, right? So something like 4,000 or 5,000 just at this strike, right? Into the end of the day here. It's quite a lot of volume, right? They can just vacuum these up. And then after while they've entered into their short position here, then they can just all of a sudden cover their short position all at once. And then it rockets up the price of these out of the money calls that they just acquired. So, you might say, what's the point in doing that? Like, you're only making kind of pennies on the share. Well, you may be making pennies on the share, but, in what is this? The span of a half hour, these calls went from being worth 28 cents to maxing out at almost $1. So more than a 300% trade. And, you could have gotten thousands of them cheaply all throughout this period and bought them up slowly. So what I thought was interesting today is that I posted this on my page earlier, right? So Ultimator, in particular, who does some good work over on Superstock and also posts 2x, found out that with these Chicago trades, basically Chicago trades have this regulatory exemption where you can enter in, right? You can enter in, say, a short equity trade and a long derivative trade. You can enter a bullish derivative trade and a short equity trade, which is a bearish trade, and then as a multi-leg trade. So you can short the stock, but then, and purchase your derivatives not exactly at the same time. It can be sort of assessed over a period. And then on the other half of that, right, you can just cover only one leg of that trade and you can leave the other one open. So basically, he pointed out that from a regulatory perspective with Chicago trades, doing this exact thing, right? So shorting the stock while the stock is down, while IV and the price goes down, purchasing, say, out of the money calls, short dated out of the money calls, with the knowledge that you are going in a short period of time to very quickly buy back your short position, right? Buy to cover and close your short position. And then as you do that, it is going to pump up IV because you're going to do it quickly, right? You may do it even more quickly than you actually opened your short position. So you're going to do that very quickly. That's going to pump the premiums on your options contract by exacerbating implied volatility and by moving the price up. So, if it might even bring some of these contracts in the money. And then as you do so, this will attract attention, right? It'll attract, on the one hand, it'll attract IV sellers, and it will attract, retail buyers, especially interested traders who want to try to make money off of that movement, curious to see how far it goes, and then can use that incoming liquidity in order to exit their positions, right? And then you make a ton of money. And so even though you say, well, that doesn't make sense, right? Because it's only a few cents, you have this risk if maybe you're not profitable in your short position. Well, yes, but if you purchase long derivatives at the right moment, you can make, at scale, several 100% on that trade, even though the short positions themselves aren't necessarily profitable or egregiously profitable, something like that. So interesting to see that is specifically allowed, and there is a particular regulatory exemption for that with Chicago exchange trades. So it does look like from our that type of thing, exactly that type of strategy may have occurred earlier in the week. Yeah, interesting. Any questions about this week's? Let's slice this up before we move into our next topic. Any questions about what stuff went on this week, or options dynamics, or stuff that had to do with I don't know, some of our price movement dynamics? Roanoke has a question here. Roanoke says, did IV levels move down to after Q3 levels, indicating an upside reversal? Good question. So they started, actually, yeah, they did start. So they started to move low enough for me that I actually entered into some far in the money long call positions. Yeah, so if we zoom out a bit, it's not as visible here. Oh, excuse me. I have to go to Alpha Query here. I want that share this tab instead button. My platform doesn't let me do the share this tab instead, but it's okay. There we go. Okay, now I can't see this, so let's make this bigger. Yeah, so you can see this visualized a bit better here with our 10-day mean. No, this is a little too big. There we go. So yeah, right. So so we had our kind of Q3 earnings dump here, right? Immediately afterwards. We didn't get quite as low, but we got almost as close. So I think I pointed that out going into Monday's trading, was this? Yeah, and we did get pretty low. Like within certainly like on Schwab to within a few percentage points. So it did make, while I didn't think like, okay, this is going to be a big upside reversal necessarily kind of right away, we did get that, right? So we kind of bottomed here, excuse me, in right in the middle of the right in the early part of the day, or the first half of the day, that we got that first Chicago order. So actually, let me go back now. I have to share the chart again. I need that share this tab instead button. That's what I need. There we go. So yeah, right in here, right? So on this dip, basically the IV bottom in this whole range was not actually the lowest price point, which was on Friday at open, but actually on Monday at the bottom of this run here. Yeah. That was like 102, something like that. Yeah, 101, 102. Get in here. Get over here, yeah, 102%. Yeah. So I did enter some January 2026 $20 calls for an intrinsic value play to start to bet on that. But then it started to move up basically before I was kind of fully into the position, which is fine. But was thinking maybe we'd get something like that. But I thought, okay, maybe we continue down. Maybe it just kind of cools off. But that was not in the cards. Apparently, whoever was playing this decided, nope, IV goes up now. Yeah. This is also a good question from Maxi King. Yeah, when do I think the IV rise for Q4 will start again? That's a good question. It's pretty religiously 10 trading days. It's 10 trading days. So if we go back, actually, Alpha Query is great for this. This is something that I noticed on GameStop. I forget exactly, again, whoever this user was that noticed this Alpha Query chart. Pointed out this pattern, and then after doing a little look in myself, I realized that it was earnings periods. Yeah, so let's zoom out from here. Let's do 5 years. All right. So what Maxi King is pointing out here is this earnings effect. So heading into, I got a little choppy here, but basically we had pretty big IV peaks that were around earnings. So this was the Q4 earnings in 2020. So Q4 2019 in 2020. Then we had another peak here. This was Q1 earnings in 2020. Q2 was right in here, right, in 2020 as well. And then here's Q3, slightly after this. And then, of course, this was the sneeze, but still we had IV stayed up here with March OPEX. Yeah. And then it stayed, we also had it in the rest of 2021. So we had another one at OPEX here in June. We had another one into September. So they actually stayed through all of 2021. This period stayed through 2021. We had another one leading up to, what got weird was 2022 into early 23. So this was a weird period for the stock. There was a pattern that developed in 2021 that seems obvious, that was connected here to OPEX periods. And in fact, we'll kind of get to this in a bit. The DD that I want to pull up for you guys is some stuff by this user Gherkinit, who some of you may know or may have been familiar with. He's a guy who is writing about GameStop he pretty consistently for about 3 years, from 2021. From 2021 up to basically the middle of 2024. And then somewhere around June, so June 28th, I think. So actually, like right around the time that I started writing myself, he stopped writing about GameStop regularly. But you know, he still follows the stock and stuff. But he's got a ton of material out there that's worth taking a look at. I haven't worked through all of it myself, but yeah, you know, I mean, he kind of nailed down this OPEX theory and how these price runs correlated with OPEXs that, you know, the quarterly OPEX dates that had to do with that connected to earnings. And he didn't specifically point to earnings, but saw the runs kind of, they weren't solely associated with earnings, but certain OPEX dates. And then we'd have these IV spikes that had to do with earnings. So, but anyway, back to this question of Maxi King, right? This pattern got disrupted through 2022, maybe because like retail traders or institutions caught on to this pattern too closely. And in 2022, it got disrupted and it was all over the place. I mean, we were also in a bear market in 2022. So that may have played into whatever was going on with the stock then. Very, very difficult to say. But 2023, even though GameStop was still on this general decline, we went back to having this really regular IV spike sequence, right? And in fact, the Q4 earnings report from 2022, which happened in the first quarter of 2023 at March OPEX, resumed this pattern. So this pattern has stayed in place. It was also still in place here during the May-June run. Obviously, you know, Roaring Kitty, his activity or whatever he tweeted on top of really spiked IV prior to earnings, but we still had an earnings run up, right? The 2 weeks in between basically the first peak and the earnings run up, right? We still had that. Okay, so that was timed up. Then the next one we had here, yep, right into earnings. So all of these basically, even this one, right? So this is kind of lost a bit in some of the upward volatility that we've had in this trend, but right, we still had basically an earnings appreciation kind of in the background, right? Our price was somewhat down in here. It traded down very heavily. That was the heavy amount of Thanksgiving shorting, which kind of masked this a little bit. If our price stayed up here, then IV really would have spiked. But so it got shorted down a bit. But then, yeah, it's exactly a 2-week period every time. So I guess we don't have an estimated date here yet. But from, I guess, Ryan Cohen's intimations about when revenue, I guess we do have an estimated date there. They're saying the 25th, which should be around then, 25th to the 26th. I forget exactly I speculated about this that had to do with that, you know, 10 plus years experience, like coding dev job, which isn't possible prior to the 26th. So, you know, that was sort of an intimation to me that perhaps Ryan Cohen's got something big on the horizon to start after the earnings report, after the yearly earnings report. Maybe he's going to drop a bomb in there. So it should start if that's the case. So we're going to count back, 14 calendar days. So that IV appreciation effect should start on the 11th of March. If earnings is on the 25th, then it'll start on the 11th of March. If earnings is on the 26th, it'll start on the 12th of March. But I will say, be careful. If we're in this type of trend here, it may not be like, okay, so for example, we got the Q2 earnings report for this year. We got that IV pump. Let's see. This is 9:30. That's too late. It's back. Well, that's here, but here, right? So here's earnings. We got that in here. And what we saw just prior to this, we had some shorting and a big sell-off because it was announced, I think, on that would be, so I think it was announced in here on the 28th, the 27th, the 28th. 28th, I think it was a Wednesday. It was only announced exactly 2 weeks before. We had another kind of big day of shorting and sell-off, and then we had a gamma ramp set off on the 29th and 30th, which then started this IV kind of uptick effect, and it just kept picking up, and then kind of set off the perfect IV sale situation right before earnings. That was exacerbated by the announcement of the additional 20 million share offering, and IV sellers rejoice, something like that, and it immediately fell off a cliff. Or wait, you can't see that because I'm sharing this. This is why I want the share this tab instead button. Like, what is it? Google Meet has like share this tab instead, but not StreamYard. Yeah, there we go. Now you can see. Okay. So, yeah, we got shorted down here into the 27th. 28th, I think, is when we got the announcement. 27th or the 28th was the announcement of the, I think it was 27th because the 10th of September was the earnings report, which was a Tuesday. So 27th, we got the announcement. We had already started to sell off into that. We got shorted down pretty hard, ran into a 2-day gamma ramp here. Culminated on Monday. We got shorted down a little bit, then got picked up again by Roaring Kitty having a tweet on the 6th. So we kind of flattened out here, and then Roaring Kitty had a tweet come in, blew up again, and then into the next week we touched 25 and then sold off super hard. And yeah, then IV over the course of that week bled, and then we went into another gamma ramp where we had this 62 million share day traded, and that completed the offering. So yeah, so it in a range bound situation like we were in here, where we were kind of flat, right? That type of appreciation effect is gonna look different, and trading it is gonna look a little different than we did here, right? So here we had a similar kind of short down, right? Immediately we got the announcement, heavy short. That turned out to be as low as we got, but then, because we were kind of moving up and down, we were kind of all over the place in here. Then we had a Roaring Kitty tweet in the middle of it that kind of, it looked like they were trying to push us down. I wrote about this. They looked like they were trying to push down, short hedge funds, something like that. We're trying to sell this volatility, which, the peak of our run here just prior to Thanksgiving reached an implied volatility value that was higher than anything in the pre-earnings 2-week period. So IV had already gotten super high. That IV sales, volatility sales, picked up a lot as soon as the date got announced. There was probably some anticipation that there would be another at the market offering. There wasn't, which meant that what I think happened here was there was an overcommitment, right? We started to see long puts come in right around here, right? People were anticipating we were going to get pushed down into, actually, let's go to our 4-hour chart. We were going to get pushed down into the 204-hour moving average, right down to 25. It really did look like we were going down there. We had broken support at the 104-hour moving average. And yeah, basically I had started to reposition myself because I was like, oh, okay, technically we just like said fuck off to basically all of our supports. Shorting was not stopping. I specifically wrote about what looked like tactical order flow rerouting to dark pools to selectively reroute orders, large orders at the ask while tactical short volume was coming in. That's exactly the time that I got my, I had a post taken down that Monday when I called that out. But that if that type of short activity ended up pushing the price past 27, it would put shorts into this this critical point of exposure that it would draw. Yeah, both to IV sellers and to anyone entering shorts below 27. They pushed it down regardless, and I was basically like, okay, well, we basically need Roaring Kitty to tweet or something similar to kind of get us out of this situation, or we're going to $25 is what I said was going to happen. And sure enough, Roaring Kitty came in, but of course not before I was suspended from Reddit indefinitely. And yeah, then we got this, and Ivy was kind of all over the place. We did have this kind of background effect the whole time. And I will say that, okay, so I had basically what I did going into this. Pro tip from not a pro. But I traded, I sold calls into this, right? So I waited for, no, I actually think, did I sell them before or after? I forgot exactly when I entered. But anyway, I sold $30 calls, right? So call wall trade. Basically find the overhead call wall is overhead, and said, okay, we're going to do going into earnings. We're going to do a call wall trade. We're going to find where the call wall is. And even if we end up at the same price, the theory on this is we're going to get it. We're going to get that instant IV crush. So it's something like, as long as the stock doesn't pump like crazy, and probably, what happened here, even though we had a really good response for the Q3 earnings, there was still an IV crush. So right immediately after this, basically as soon as the morning opened, there was IV crush. There was delta crush from the IV crush. So that's the result of that. And I exited the position for a very significant, very good gain. It was something like, was it a weekly or something I had sold? I had sold it like in here somewhere. I think I started to enter in here, and then I, after Roaring Kitty's tweet, I entered again, kind of in this range, and then of course we got a day of sell-off. This happened after hours, so that didn't really affect things. And then here we actually, right, we moved down first, and on that move down, okay, cool, right, with the IV crush on the move down, those contracts lost like, I don't know, 50% of whatever value they had going into earnings. And then it was like, okay, we're done. There you go. Exit there. It was a good response. So then good to get out, even though they still would have been fine. If I held them to expiry, they still would have been fine. But that's why you pick a call wall trade. Call wall, very strong chance that kind of coming out of that, if you got max pain below there, call wall above, even if the response to earnings is unexpectedly bullish, like we saw, probably a good chance there's going to be some crime that'll make sure that still works out in the dealer favor, right? So when you make a dealer trade, dealers work for you. That's, because they're working for them. Something like that. That's how crime works, I guess. So that's a lot of different things, but that's, kind of my experience going into these past two periods. There will be a background effect. You'll have to watch. I mean, I'll write about this, if you follow my articles and stuff, I'll write about this. I'll detail what's going on. We'll have live streams. We can talk about this as we get closer. But that is, that's something I took into account, worked out these past couple times for me. That effect still played out despite how well earnings was received. So, but very good question from Maxi King, and he is right. Yes, Wally Waspers. That's a cool name, Wally Waspers. This is The IV chart is from Alpha Quarry, so you can view 1 month and 3 month 10-day mean implied volatility. You can view that for free. You have like a 30-day trial or a 10-day trial or some kind of trial. They're going to try you, or you're going to try it, something like that. And yeah, then you can see it. Otherwise, you have to subscribe to see the farther out data. So that bigger chart that I look at is I have a subscription to Alpha Quarry, so that's how I can see that. That is paywalled. Yes. Yeah, so it'll start up 2 weeks. Short answer is it'll start up 2 weeks before the earnings report. So should begin around the 11th to the 12th of March. So yeah, so I wanted to, let's see where we go first. I guess since we started talking about the Pickle Man, we will, where's my, there it is. Okay. Do we want to do Pickle first? That's not how I play it. Yeah, let's do Pickle. Let's do the Pickle guy. So let's go here. Zoom in here a bit. Yeah, so this is, somebody sent me, whoops. So this is a guy who's been writing for a while. I don't know if how many of you know this this Gurk dude. Gurk. I don't know if it's Gurk, isn't it? Like it's British. Like he's like, it's Gurk, isn't it? Or it's probably just like beating off, like gurking it, like jerking it. That's probably right because it's a pickle. But in any case, yeah, this, somebody finally sent me, actually it's Ken, if Ken's here, my Danish friend, I don't know if he's here. Yeah, sent me some stuff by Gherkinit this past weekend. So I had a look at some of his older DD, and he does a pretty good job. I mean, it's very well laid out. It's detailed, but also has some very clear charts and breakdowns that he's written out that describes his model of what drove the price action events in 2021. So this he put together, right? This he put out after the SEC report came out, after after Spot Gamma had written about this, after kind of a lot of the dust had settled, with the particular thought in mind of being able to anticipate and time these ETF cycles. Really, what he says, and as I've discussed before, as otherwise Category 42 is discussed, as Richard Newton is discussed, right? As this concept as it's circulated around the GME sphere, that the price action was driven, and many of these sort of echo price actions in 2021 were driven by a concurrence of ETF liquidity cycles, so ETF FTD cycles, the necessity to create liquidity using ETFs, fail to deliver shares of GameStop, like use shares borrowed from ETFs to meet delivery obligations without covering short positions on GameStop, and then to buy shares of GameStop at more favorable prices in order to cover fail to delivers in ETF. So this type of cyclical action. Swap rolls, which I still do not terribly well understand, but sort of the relationship between these two cycles, and then option cycles on top of that. So the reason why this person, why I think Ken sent this my way, and why some other people have pointed Gherkinit to me, is the degree to which I've become interested. Right, every day I try to understand market maker hedging and gamma hedging in particular. So the effects of gamma exposure on our day-to-day price action. Right, I think that being able, one thing I would say that seems to have given me a reasonably accurate predictive ability with respect to my trades or the way that I guess I've been analyzing price action, at least over the past year or so, a little bit longer, right? But sort of kind of repeatedly and consistently, well enough for my own profitability month over month. I guess, fair's fair, right? Jury's still out whether I've just been lucky for 8 months now. That's perfectly possible. But I would say that what seems to help me both have a more optimal degree of precision without sacrificing accuracy with respect to a lot of my trades has been that I've been able to make some sense out of gamma exposure data. So Gherkinit here back in 2021 also was able to spot the importance of gamma exposure, market maker gamma exposure, dealer gamma exposure, and large dealer gamma exposure expiries as being another important layer, a third layer, let's say, in this sort of this event overlay, right? These cyclical overlays that resulted in this upward volatility in 2021. So he's got an older, his sort of first really big project on this that if you haven't had a chance to check it out, I'd really recommend that you do. I want to draw our attention here to the third part. It's called The Book of Moas. Curiously, not found in the library of DD. I couldn't find it in the Superstonk library of DD, even though it is a Superstonk post. Yeah, right. So very interested in gamma exposure. He approaches it a little differently than I do. I tend to try to figure out how to make sense of gamma exposure by strike and how that can kind of frame our price action on a day-to-day basis. He relies on an understanding of where, let's say, like gamma neutral and what he calls gamma maximum lie. He's also designing a platform right now, which is interesting. Something, I guess, similar to what Unusual Whales, to what Spot Gamma offers, called Gamma Strike. It's in its beta stages now, so you might want to look into that if that's something that you're curious about. Yeah, so this is what was interesting to me that he pointed out, right? That perhaps one of the reasons why we got this sort of upward movement in, and may have been in place for upward movement again in 2021, were it not for a heavy amount of shorting that came in, that because of the ETF and equity leap cycle. So there are three, I believe, equity leap states throughout the year. So June, January, and December as well. So you have these three very large expiries. So this is from his post here. Oh, wait, you can't see this. This is what I wish to see. There we go. Now charts. So the fact that there was a large amount of gamma exposure that was coming due, that came due at the end of December, that came due at the end of January, and then in June, likely is what drove the GameStop runs in 2020 into 2021. That was this additional component laid over the top of roll cycles, right? So swap roll cycles here, which we see in this first chart, right? So something like, in particular, how this looks, right? November to January roll cycle. Then how this sort of ETF failed to deliver cycle looked. And then the overlay of these large gamma expiries, right? So something like this, right? How these overlaid with one another, and then how they were exacerbated by the fact that going into these very large gamma expiries, options activity combined with, say, this kind of background, maybe covering or settlement activity, particularly agitates market maker hedging heading into these coincident ETF and equity leap cycles. So that these had a very significant effect going back to 2020, 2021, that there was a chance for this, right, to happen again in late 2021, but that it was stifled. It was, there was a way, right, understanding that this could happen again. Whoever was trying to avoid this, package this up, maybe put it together in some different swaps, change the swap cycles or something so that this wouldn't happen again, engaged in a lot of very aggressive shorting, and basically stop something like this from happening in 2021. What I found very interesting was that this pattern, right, this kind of upward pattern here that overlays with these cycles looks fairly similar to what we're looking at right now, coming off of, if we go back over to our chart, another major June event, right? Another leap state. So we are approaching another one of these, right? So if we zoom out here, we can't quite see this, but right, if we zoom in, we had this kind of upward channel we were in. Looks a lot like, as I pointed this out, but on a 4-hour chart here, right? Same frame, actually right down to it, right? Started right at the end of October, picked up all throughout November into December OPEX, right? We had this, earnings related activity, but here we go. We're kind of back on the path. We're in here again. Is it possible that after this kind of bear market phase in 2022, after this heavy shorting that kind of stopped things in 2021, really down to the days, is what's driving this price action an overlay of some of the same factors, right? Some of these similar cyclical elements. This is my question, because I don't know, maybe you guys out there, right? You guys know somebody, right, who's thought a bit about this. I'm trying to figure it out, right? Is it possible that Roaring Kitty is tweeting on some of these dates that help us mark, say, some of these ETF fail spillover, these roll dates, right? That the coincidence of this in say June, and now what we see in this November to January period, we're approaching another, our largest gamma expiry of the year. So in 2020 on January 13th, we saw this really big upward volatility event begin on right here. This is when we started to go exponential, was on the 13th of January. Now that was a Wednesday, right? When was actual OPEX? OPEX was the 19th. So 13th is that right? Or is it the 18th? No, it's the 15th. So it was 2 days earlier. So it happened 2 days before OPEX. Okay, but by that point, a very significant amount, an unusually high amount of this options chain was in the money. And too far, yeah, it was the 15th. Noodle Soul's right. So it happened 2 days before it. So I know a lot of people are getting excited about the 13th. But what I think here, sort of what is suggested perhaps from the importance of this very large gamma expiry, right? So both this ETF and equity leaps co-occurrence date here at January OPEX. What seems to be operative, the operative component with respect to maybe this compounding effect, is not so much the date January 13th, that particular day. I know a lot of people are getting stoked about this, but the fact that January 13th was 2 days prior to OPEX, this very large OPEX with a huge amount of gamma expiry, and that, or huge amount of gamma exposure, I should say, and that basically this move put a huge amount of that options chain in the money unexpectedly, and basically threw off these cycles and required sort of the oops, gotta throw this down the road, we gotta pull this lever, right, do this, and that set off this bigger chain reaction that then culminated in things going viral, right? Part of what drove this was stuff going insanely viral. And these last few days here of like this stuff was, a huge, like people say retail, but like, we have to say like this stuff here was something like, Wall Street bets, playing options. And this was something like, 5 million people taking their, stimulus check from COVID and like buying 10 GameStop shares at $300. So that's this. And then what Gherkin also talks about too is one of the reasons why turning off the buy button caused this sell-off was perhaps not so much the sale of shares, but incentivizing people who had, say, held calls all the way into here that had required market makers to go and hedge shares, right? While you hold an option, right? While you're holding a call, let's say a long call or a short put, then the market maker has to be hedged, right? Has to hold shares in order to hedge your position, because there's always this chance with an American style option that you can, as Thomas Petterfy pointed out, the holder can go ahead and say, I would like my shares delivered. And they are under obligation to give you those shares. They must deliver them. They cannot FTD your options obligation. They must be given. So they had at this point T+2 to get them. So they'd have T+2. They'd have 2 days to go out and buy them. Now it's T+1. They'd have 2 days to go out and purchase them in the lit market, whatever they didn't have already hedged, to deliver them to you. But basically, right, people held. And then the buy button got turned off. And then with IV levels high and the price doing weird stuff, rather than exercise, rather than demand shares, with the buy button turned off, maybe seems like people got spooked. This is basically Gherkin's conclusion there, that, right, people just started to sell their calls so that instead of having share settlement for their options obligations, dealers instead were able to cash settle their obligations. They didn't have to go get shares, and they could then de-hedge themselves of whatever shares they did have, which then that de-hedging maybe combined with a very high volume of put sales, put buying from institutions and such, rode this into the ground. But of course, not before that did that several times, right? We got kind of repeats on this into the potential to kind of bounce back here, right? We had a chance to do this again going into the end of the year, as Gherkin had pointed out, but of course, very heavy shorting right around the 29th into Q3 earnings, which looked like, right? It looked like maybe we were setting up to do something just like that, but then the lack of the at the market offering, the good results from Q3 earnings has kept us on this trajectory. So maybe, maybe we don't get something like this, right? Like certainly this guy Gherkinit does not think that something like this is possible again, based on some of the regulatory adjustments that have been made, and the fact that there were in the summer. I think this is why, in part, conjecture, he may be a bit checked out of taking a look at whatever GameStop is doing now. I mean, he's an experienced trader, right? This guy's job is he's a trader, and he's got an extensive online business, coaching people and stuff, live streaming and whatnot. So he's looking at other stuff all the time, right? This is not GME is not the only play in the market. It may be the easiest one to get into because there is so much public information that's accessible. I mean, there's a lot of stuff to wade through, but there's so much on this, and there's so many people who are invested in this. It makes sense why this is something that certainly draws attention. There is, quite a lot of opportunity in this. But I mean, if you're looking at 30 other things, right? Like, Roaring Kitty is not only playing GameStop, right? He's been in Chewy and whoever else, whatever else. Maybe Unity. I mean, who knows? Who knows? So, maybe it's not going to look like this, right? It's not going to look like we go from $4 to 120. But I think, as I pointed out last week too, or earlier this week in some of my videos, can we get back? How many years can we get back? We could look like, this. We had something like this in 2012. Same things came into play, right? Same movement in 2012, right around the OPEX cycles, right? Actually started earlier, but starting end of July. Actually, in 2020, this movement started in July. It kicked off with some heavy Chicago exchange volume, actually, in July, and then we started to trade up right through these OPEX dates, and then after some stalling, right, actually it traded down into the beginning of the year, popped up a little bit, stayed above this 200-week moving average, just like we are now, just like we were in 2020 and 2021, and then a slow ass. Right? Not a mo ass, like a lot of people are like, oh, that's going to go to cell phone numbers, which, hey, cool if it does. But, what's wrong with this? This could be awesome. Like, I'd be down for whatever this is for, a 200% increase in the underlying in a year, which, oh, by the way, we had this year anyway. And now you're saying maybe like a 200%, because that's what this is, right? Yeah, this is what? This is like 100%, right? This is doubling. And then from that doubling, this is 200%. So in a year, and so basically one calendar year, that's 300%. Okay, that's kind of cool. Well, it depends. This is a good point. Retail doesn't have the money to exercise multiple contracts. Yes, but of course, it depends how high it is, right? You can also do things like there's an option with your broker, like you can do I forget what the name is, but you can do this settlement where basically you'll say exercise, you want the shares in the money contract, and you will the contract will be sold. The extra value in the contract, right, will you'll get all the shares, but then the shares will be sold up to the point that you have money that you can exercise it, and money will be taken from the shares that are sold to purchase the other shares based solely on the value of the contract. So you could end up with 27 shares or 40 shares rather than 100, and the cash that you do have, the cash value in that, will be used to pay for that smaller number of shares that you can't afford, right? Something like that. So there are brokers that do that. Sell to exercise. That's it. Sell to exercise. Thank you. Sell to exercise. You can do that. I mean, maybe as long as you're not in Robinhood, right? Fidelity doesn't do it. Oh, that's very interesting. I have to figure that out. You can do that, right? That's what Roaring Kitty did, right? Roaring Kitty didn't have the money to exercise his $120,000 $20 calls in May and June, so he sold. Actually, wait, did he even exercise those? I guess the Bloomberg terminal said he did exercise them, but it's possible that what he did was sold them all and then bought something like that. Yeah, that's what I thought. Yeah. Well, because we got the, I mean, it's possible, right? I thought that's what he did, right? When I was writing back in July, I thought that's what he did, specifically because we got that little run in July. No, we don't want weekly one day. We got this, right? This move, which was more or less T plus 35 from when he made his purchase, right? When he posted that YOLO update, that would have been around T plus 35. And then it sold off after that hard, right? So this was like, this move seemed to me like a slow accretion, like trying not to spike IV, a slow accretion of shares to meet that obligation in time. As it did so, I mean, a ton of people, again, right? This was Lenarius's ban bet, was that like it was going to explode like on this day, and it did, but then it didn't go to $1 billion, like it went to 30 from 22, right? So like if you saw this move and you're like, oh cool, yeah, T plus 35, let's bet on it, and you bought calls, I think like here I bought $25 calls. And I was like, okay, like we'll just see how high we get by this date, right? Let's see how far we get by this date. Oh, okay, there's a call wall at $30. It's probably not going above, right? There's COGX right there. Low probability it's going to go through that, right? Sell some of it, right? Like take profits because there's a call wall, and they're probably not going to let it close above that call wall, right? Cool, it made it through 25. That was a cool step. But then yeah, and then we reversed, and then Nikkei crash, and that was August. But then cool, Nikkei crash, because then you all got to buy a ton of shares for $19 or $18, which was cool, or enter into some really awesome cash secured puts, which are super cool. Mm-hmm. Yeah. Oh yeah, interesting. Yeah, it may have been me, right, Maxi King. Yeah, that may have been me. You may be using me as the source. I have no idea, right? I mean, I don't have the ability to verify that that's actually what happened, but I operated under that assumption for that trade, and for predicting what was going to happen with our price. And that's what happened, right? So that doesn't make it, what is that? It doesn't make what I said materially true, but it does make it functionally true, something like that, right? My method of approaching the prediction was good enough to anticipate the result, but it may not accurately describe the mechanics underlying that prediction, right? It may have been something else going on there. Yeah, but good to point that out. Yeah, William says, yeah, Bloomberg. Yeah, you're right. Bloomberg, this is interesting, William, because Bloomberg did say that's what he did. Bloomberg said that he sold some, he cash settled, 80,000 of them, and then exercised the other 40K. So anyway, point here, which is good to visit, is you can cash settle a portion, something like. I'm not right. I'm not giving you advice or saying that if we get into this situation, exercise your contracts. You have to do what's right for your for your portfolio, for your investment strategy, for your trading strategy. Roaring Kitty had a way of going about stuff, and I guess, right, this is something I guess that Gherkin Knit was somewhat upset about, was that I think, right, he basically laid this out and said, like, oh, if this happens again, and then everybody exercises their contracts, like the Pennerfee thing, like it'll go to the moon, and like there will be real MOAS, was basically he was saying all through here. And then this occurred, and then there were the dilutions, which sent in a ton of liquidity, which then allowed shorting, allowed this kind of shorting and shorting volatility cycle. So this is another thing he points out. This is something I wanted to draw your attentions to over here in his part 3 here. Is it part 3? I think it's in part 3. He's got the image. No. Where is it? Part 2. I think it's in part 2. He's got this image. Oh, no. That's a different one entirely. It's the river. Here it is. It's when the river runs dry. So let me do this. He's got a ton of this stuff out. His stuff is like, it's kind of all over the place. Like it's kind of hard to pull it together. Some of it's put together quite well. It's all kind of laid out there, and he's got links within the articles, but some of the other stuff is in a bunch of different places. It's on a couple different subreddits. Yeah, right. So he does a good job of, I'll show you this here. You can go back and check this out and read through it bit by bit yourselves. But right, basically he's got this image of, this metaphor of how GameStop and these other basket stocks are set up, how these FTD cycles, shorting, maybe swaps as well, and options activities, how these are coordinated in order to create this kind of this money-making machine. And basically, right, the first step is you can short and you can sell volatility, right? So as the price goes up, right, as the price is at some point, volatility is up. Let's say there's an up move in GameStop, the company's doing well, right? It's exciting. There's unexpectedly good news. Volatility goes up, price goes up. So you, with the ability to affect the price, you're an institution, you short the stock. So you dump short volume on it, and you sell volatility, right? So you sell you sell calls because people get excited. Okay, those calls bleed. IV goes down as the price goes down, and then but you don't want to pay, right? You don't want to continue to pay the borrow fee necessarily on your short position. So what you do is you go over, you do an ETF creation order, you get shares of the company from the ETF as a part of this creation order, and then you close your short position with the shares of the company from the ETF. So now you're not paying the borrow fee on GameStop. You don't have to pay the cost to borrow fee, whatever it is, in order to short the company, and you don't have to buy back the share immediately, causing the price to go back up and causing you to lose money on your short volatility position, right? So you short the stock, sell it, offset the short position in an ETF. You fail to deliver, however, because you might say, oh my gosh, but like, what about the ETF? Don't you have to pay to like borrow that share if you don't immediately like return it or something like that? It's like, no, you don't have to do that, because you can fail. You can say, oh, sorry, we don't have it, right? You can do that infinitely, because you can do infinite creation orders from an ETF. Okay, you have an FTD cycle. You do eventually have to close out the position. So, but what you do is, like I just described, like Ultimator described today with these Chicago orders, in like on a larger scale, on a longer time scale rather than on a smaller scale, right? What we described today is on a smaller scale. What we saw happen last Thursday, Friday, Monday, Tuesday, this was a small scale iteration of this, right? You time up when you're going to actually go back and close your synthetic short position. So you wait until, okay, you've profited now on selling volatility. Now volatility is low, so you acquire long volatility, right? You go long volatility by buying inexpensive contracts. You move out of your positions that were short volatility, and now they become net long volatility. You time this up with high gamma exposure expiries, right? So OPEXs, things like this. Doesn't necessarily, like, you can do it on a small scale so it's a weekly. That's why, for example, we more often than not, we see these types of runs, these gamma ramp events take place on Fridays, because these are options expiries, right? GameStop's options expiries are on Fridays. This is why we see these on Fridays. This is when gamma exposure is about to expire, and it's when contracts are most sensitive. Their delta values, especially out of the money contracts, are most sensitive to changes. Their delta values are most sensitive to changes in the price of the underlying, which means that their gamma values are highest. So then once you've got this position, you go, you purchase, right? You hedge the incoming upside move that you yourself are going to cause, because now you're going to buy your shares so that you can give them back to the ETF and get your FTDs off the board. Okay. Do this again, right? Cover all your FTDs and short positions from the previous cycle. Now, in 2021, this heavily aligned with quarterly OPEXs. Okay. It did not so much in 2022. It did not so much in 23. It did not so much. Has it this year? Monthly? I don't know. Not monthly. Quarterly? We did in September. Not so much in November. It was after in November. I mean, OPEXs typically are higher. See, this is the thing. It's not OPEX itself. It's the degree to which OPEX serves as a high gamma exposure expiry point. Now, in a super flat period, that might not be the case, right? OPEX may not be a super high expiry point. So we kind of got there into November. December, we got one actually into December OPEX. Small, but we got it. We've had bigger ones not necessarily connected to OPEXs. But I think, what's important is the degree to which it serves as a high gamma exposure expiry. So, right, so then you do that, and you can repeat this. You can lather, rinse, repeat this. And it's free money, right? Because the idea here, it's why this chart is really good, right? New people, new buyers, retail gets excited about potentially having these types of returns, right? Oh, hey, these small and these mid-cap stocks, right? These basket stocks, of which GameStop is the one par excellence, right? This attracts new money. So, how many people really get stoked to go and buy and hold shares of Apple? Not a ton. How many people do that necessarily with index funds? How can you make money necessarily off of other people just buying shares of index funds? If you're a proprietary trading firm, if you're a hedge fund, if you're a market maker, well, you can do it with options, right? So what they did to monetize the index this year, which actually started in 2021, was zero DTE options in the indexes. So you could do daily zero DTEs on SPY. That changed SPY. So that basically put SPY into the category of these small and mid-cap equities. Although it behaves differently in terms of its volatility and price direction. They can make money in a way they couldn't necessarily before to the same extent. But you're still not going to get those same kind of outsized returns, right? The idea, if you shrink the time frame, yes. But something like GameStop in 2020 is, okay, wow, this thing can really yoink. So I'm going to go put my money on options. I'm going to go bet on long calls. And then you get fleeced in one of these cycles. And most new retail buyers, right? Even people who have been trading for years necessarily, who don't know that you can sell options, or don't find the rates of return in any isolated case particularly appealing on short options. Don't know that. Don't do that, right? So that's how dealers get money to flow through this system, and that's how they profit tremendously off of this. So yeah, Gherkins is he's the Pi-Fi guy. Yeah, he's got his own Discord. He does his own stuff. Like I said, he doesn't really talk about GameStop anymore. He kind of stopped with that in June. He spent a lot of time thinking about GameStop, and I think he's just kind of done with it. Like periodically, he'll like over the past week, I got in touch with him, and he answered a few questions after some time. But I think he's got some GameStop fatigue, and he's doing some other stuff now with his group. So, but I just wanted to point this out. It's definitely worth taking a look at, right, to get a different angle of approaching this. For those of you maybe who have only heard about some of this from me or from Richard Newton, which is great. Absolutely. Go listen to Richard, go read otherwise categories DD stuff, just to, hearing some of the same ideas expressed different ways by people coming from different backgrounds and with different, let's say, ways of visualizing this model, like, can help create a better composite picture of exactly what we're looking at here. And then you can go and then you can, take these and, go fool around yourself and say, like, okay, like what happens, when you're watching the charts, you can kind of put together your own thing and see how that makes sense. So definitely would recommend this. Go check out this stuff. It can become a very, very deep dive. But I'll be digging into some more of this stuff myself in the weeks to come as I keep an eye out on what we're looking at. But yeah. So the question then is, are we, because we look so similar to this? Immediately as I looked at this thing from him back in 2021, I was like, oh, that's the thing we're doing now, right? That's maybe what's really going on here is something that has to do with these gamma expiries, these leap states, and the co-occurrence of these ETF and equity leaps expiries, something like that. So in any case, and then on top of that, right, the what I wanted to sort of as the cherry on top there, that if that is the case, then what is likely the important date to keep in mind for this week may not be, Monday didn't happen, shucks, but, the day or two, maybe Wednesday, right? Maybe it's the 15th this time. It seems that what was important was that options chain got blown out considerably, and a ton of positions that were short volatility all of a sudden were in the money, and then had T+2 to cover, right? Had T+2 to get shares and deliver, and that messed up the ETF and maybe margin deferrals from earlier in 2020, like what otherwise category and Richard have been talking about. So that's something to keep in mind, right? Even if January 13th, okay, it's a rhyming date, but maybe that's not going to be the date that, if there's going to be a play, if what really is operative here is this leap state, is this January OPEX, then I would say, a tweet from Roaring Kitty or some dynamic that tries to exploit that and tries to maybe squeeze out short volatility from that chain is going to be something that's going to come later in the week rather than earlier. Earlier in the week, right, there's time to adjust to that. There's time to move the price down. Later in the week, right, so for example, with December, the December 6th, with the December 5th tweet, there wasn't time, right? There wasn't time to necessarily move the price down too dynamically after that tweet. That had to be failed. And there were a lot of, it's likely because of, maybe because of that later on in the month, XRT went on Reg Show. There were a ton of fails. There were a ton of fails on XRT actually that day. the greatest number in a while. There were a lot of GameStop fails. Where I had this pulled up. Yeah. Actually, it was the day after, so on the 6th. So on that options expiry, there were 171,000 fails on XRT. So very considerable amount. So yeah, right. The move to play. There were 115,000 fails the day before, where we had a lot of shorting, and then there were 171,000 the day after. So something like that, right? I'd be looking more towards, and I'll write about this next week too. But, something in the middle of the week or later in the week to try to take advantage of that really, really stacked options chain. So Cole asked, when I'm shorting volatility myself, I'm usually selling covered calls. I'm usually selling covered calls. I have in my shares, and I use gamma exposure points to plot my trades. But if I think, this is the other thing, and this is why I'm paying attention to these OPEX cycles and to these ETF things, and why I'm so I want to try to understand this, is because I can avoid. I don't want to get assigned, right? I want to hold my shares. I want my shares and stuff to continue to play out. I want to see what happens. I want to keep going, right? I'm not trying to necessarily, ideally I would use knowledge of, oh, hey, maybe this week there's going to be some crazy upward volatility event. I'm not going to sell covered calls, right? Even this week, right? I was a little shy heading into the end of this week. It was like, IV's doing weird stuff. The technicals look weird. We're getting these Chicago orders. Okay, early on, open some positions. Very beginning of the week, I opened cash secured puts. And like I said, and long calls earlier in the week. And then some, I shorted volatility midweek, and then closed early, kind of bumped up a little higher, de-risked, something like that, right? If I want to de-risk, I'll just kind of bump up. I'll say, okay, what's the next call while up? Right now it's 35. All right, I'm not liking how this is. Bump up to 40, right? That's going to be the next call up. That's that next bracket up. Okay, let's go. Let's just reduce the risk profile by bumping up there. Is it going to be amazing? Am I necessarily going to get the same returns? No, I'm probably cutting my returns down by in half or maybe down to a third or something like that. But it's better than no money, and I'm not feeling comfortable this week with kind of this uncertainty or what's going on. So, and that's worked. I haven't been assigned yet. So, we will see. And two, if something happens kind of midweek or the threat passes or something like that, then, I can reposition, kind of bump down, something like that. But I try not to do that too aggressively. But that's a good question. Maxi makes a great point here. Yes, King. Go off, King. Yes, it's not only betting on the direction of the stock, but also on the direction of the volatility. Yeah. So you can do certain options plays that are going to be less volatility intensive. So one of the reasons why, when I'm doing long calls, I like to do deeper in the money stuff is because it's less dependent on intrinsic value, or excuse me, it's more dependent on intrinsic value. It's less dependent on extrinsic value. So the implied volatility is still going to affect that contract, but it's going to affect a lesser proportion of the total value of premium paid. So most of that premium is going to be affected by fluctuations in the price of the underlying, and only a bit is going to be affected by volatility, unless we go crazy in terms of volatility, right? Which is kind of the nice thing about that, is that we do have these periods where GameStop can go to 300% implied volatility, and then then in the money, a deeper in the money long call can be affected when you have something like that. But it's not going to, a slow grind over 3 months where the price goes up $6 is not going to affect the volatility on that contract. It's not going to affect the price in terms. there will be a negligible effect on the price with respect to the implied volatility appreciation over that period of time. It is going to be more weighted toward the change in the price of the underlying. That is what I want to say. Yeah. So, but as you get closer to in the money stuff and out of the money stuff, that's going to be increasingly dependent on IV directionality. Yeah, on where IV is going. So that's something a lot of people, newbies like to options. Like when I started, that's something I did not take into account at all. And that, especially with out of the money stuff, is way, way more important, right? That's way more important to keep track of, because that can make or break the trade. Selling calls is not the same as buying puts. So when you buy a put, sentimentally it is a bearish trade with respect to the strike you're buying it at. But buying a put is a long possession orientation. So with a long put, you are bearish the price, but long volatility. With a short call, you are short the price versus the strike, but you are short volatility. Okay? So the difference is your orientation towards volatility. So a short call is short the stock, is bearish on the stock and bearish on volatility. That is short on volatility. A long put, a bought put, is short on the price of the stock, but long on volatility. So with a put, you're hoping that the price of the stock goes down and the volatility goes up, which is different than a short call, where you're hoping that the price would stay the same, if it's out of the money, right? But you're hoping that price goes down or stays flat or something like that. But you also hope that volatility goes down too, or you run out of time, right? You're also time advantaged with a short call. You have time working for you. Theta is working for you. Whereas in a long put, time is not. Time is working against you. So a long put makes sense, right? Puts are popular on SPY because on SPY, as the price goes down, volatility goes up. So long puts are a more sensible trade on SPY. On GameStop, long puts are a bad idea because, except for deep in the money puts. Deep in the money puts, because, you're not really, like I said, it works like deep in the money calls. Volatility is not really going to affect you that much unless, GameStop goes to like 300%. But you're kind of screwed. You're kind of screwed if that happens on a long put anyway, on a deep in the money put. Right. But with GameStop, as the price goes up, volatility goes up. So you're kind of double screwed when you have a long put on GameStop. Because even on GameStop, even if the price goes down, volatility goes down with it. So you're having multiple things work against you in order to get the thing working for you that you would like, if that makes sense. So long puts, that's why you don't see people trading long puts on GameStop. Thank you, Simple Rick. Let's see. For the next video, could you check a video titled "A Deep Dive into GameStop Institutional Puts, Liquidity Changes, and Statistical Abnormalities"? Yeah, I'll check it out. Can you put that in my inbox on Twitter or something like that? X? Could you shoot me the link? That'd be helpful. The Chicago exchange was bought by the New York Stock Exchange. Like Like it doesn't exist anymore. Like that's interesting. Maybe follow up on that. Coffee, Donuts, and Homer. Great name, by the way. Yeah, okay, back to this reg show question. Take care, Roanoke. Great to see you, my friend. Thank you so much. Yeah, Shinsasu and Desert Cactus, thinking about the reg show stuff. So what do you mean here by 13 days of XRT on reg show possibility? So I think it's already been 13 days. Well, if it's trading days, that's right. It had to be trading days. Let's see. How many trading days are we since? I forget. It was the 23rd it went on reg show. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It'd be 12. That'd be on Monday. It's definitely possible. I mean, I don't know how to give you, quote you a probability on that, but I don't know. Maybe we saw some of that today. Maybe we saw some of the closing there, but I don't know. We used to see XRC used to like sit on reg show for like, I don't know, 80 days or something. So not sure. But somebody asked about Shinsasu. Was it you that asked the question earlier about reg show stuff? Maybe you can repost your question. Here it is. No, it was Desert Cactus. So here's Desert Cactus's original question. Maybe you can explain the retro consequences of SEC Rule 203B. Yeah, I posted about this earlier this week. If XRT is on reg show tonight, that makes 13 consecutive days. So are there consequences, or is that just hoping? So the 13-day thing, isn't about there is a component, I guess, where that can be useful. So the rule 203B parentheses 3 says that FTDs, any FTDs that are opened on a threshold security must be closed. They must be fully settled within T plus 13 of the day that those particular fails show up on the stock from the first day it's on reg show. So it's something like this, right? Let's say you fail, right? You have, I don't know, 10,000. The minimum threshold is 10,000 shares. You have 10,000 fails on XRT. Okay. The next day, it goes to 20,000. The next day, it goes to 30,000. The next day, it goes to 50,000. The next day, it goes down, but it's still at 40,000. The next day, because you've had 5 days in a row of having at least 10,000 shares failed to deliver on that security, that next day, let's say it's Monday, now XRT's on reg show. Okay. Starting on that day, this is my understanding of the rule. Starting on that day, for any fails that are still outstanding from that day, it says from the settlement date, they have a total of 13 days. So they get a 10-day extension from the settlement date. So they're saying that the settlement date of those fails is T plus 3, and then they have an extra 10 days. So they have a total of 13 days from that day to close their positions. To settle those positions is my understanding. But there's nothing that says you can't fail other things. So you can fail more the next day And then that settlement day, you're going to have 13 from those fails. And then, right, so it doesn't mean you can't fail on it, but it does mean you don't get that full fail cycle, right? So from that point forward, you don't get T plus 35s. You get T plus 13s. So it cuts down the time you have to settle fails by about 60%. So it's not like, oh my gosh, like crippled. Like you can still short, you can still, you can still fail that security. I mean, if you don't, like, there is a pretty hefty penalty if you don't actually settle your trades in that 13-day window. It's that you are barred from short selling for 90 days, which is bad. Like, you don't want that to happen, which means you're going to settle your trades. Like, you'll settle, like, they'll settle their XRT fails. They'll settle them within that period. The other thing too is, like, they can also borrow from other ETFs. I guess they can do creation orders with other ETFs to cover those fails. I don't see why not, but maybe they won't because that's complicated. Because you might need to do like multiple creation orders from multiple ETFs to get like all of the basket stocks together to go return the fails like to XRT, because it's not like XRT and IWM have all of the same companies. But yeah. Yeah. So, I mean, it can gum up the works a bit. It can make things a little harder. But it's not like the, yeah, not the end of the world, I guess, for who's ever doing this. Interesting name. Dolt for the Lola. I'm not sure what that means. It sounds playful and fun. Do I see GME synergizing with a Vanna ramp? I'm not sure what you mean by synergize with a Vanna ramp. Maybe you could clarify that for me? Shukri, yes. Not medical advice. I have no idea if the SEC enforces these consequences. I guess it depends the ease at which they would do that. So, yeah. Yeah, I guess the while some people are continuing to think about questions here, the other thing that we didn't get a chance to do that I wanted to make sure touched upon is I thought it very interesting. Right, we have this tweet today from is this what I want? No, I want this. Right, so not Kevin Malone, but this tweet, right? We got our tweet from Ryan Cohen here, our reply, right? Make Canada great again, which is under this this video from right. This is from the Jordan B. Peterson podcast. Jordan Peterson is also Canadian, along with the leader of the Canadian Conservative Party, Pierre Poilievre. So I thought this is very interesting, and I mean, it seems a natural step for Ryan Cohen. In part because, one thing that I think, this is part of my interest as having studied the Renaissance, is that part of what a lot of these guys are looking at and what they're interested in, like their common interests are in understanding the structure of the okay. The first thing is all of these people are interested in the optimization of the function of emergent complex systems. So how, like, the emergent properties of complex systems and how to maximize the emergent properties of complex systems. Okay, so Jordan Peterson is particularly interested in this from the perspective of individual psychology, right? He's a clinical psychologist. His career was spent as a researcher and as a practitioner of clinical psychology, right? Okay, now he does a podcast and he came to the spotlight and he's been, a free speech advocate. He's also interested in politics. He is interested in the psychology of politics. In particular, he is interested, much as Carl Jung was, in, say, the psychology of mass politics. Understanding the psychology of ideology have been particularly interests of his. But his interest as a clinical psychologist is, okay, human beings and the human psyche, right? Human beings are complex systems. We are formal complex systems in the same way that a city is a formal complex system, in the same way that an economy is a formal complex system, in the same way that the market is a formal complex system, right? There are certain characteristics that are homologous across these different structures at different orders of magnitude, at different levels of resolution. Pierre Poilievre, of course, is interested in running Canada, right? Is interested in this particular, right, steering Canada out of this particular period of unnecessary economic decline by an overbloat of bureaucratic oversight, right? Actually, I did have a chance to go take a look at this podcast earlier today. It's pretty good. It's interesting to listen to, Poilievre talk about certain elements of the Canadian government and think about expenditures and sort of how it sort of reminds me, like his approach reminds me of like Thomas Sowell in Knowledge and Decisions, which is one of Sowell's earlier books from 1980, where he talked about, like, the optimal running of an economy, or like one thing that holds an economy back, like the lessons of the Soviet Union or communist China or something that holds back an economy, same thing that holds back a business, same thing that holds back kind of any administration is something like administrative bloat, right? Where you alienate the decision-making process from those who are most inclined to pay attention to its incentives and disincentives. So, those who are punished or rewarded, you want people who are going to suffer the price for making a wrong decision to be the ones who have to make the decision, because they have a vested interest in making that decision properly. Because they don't want to be punished for making the wrong decision. But if you remove decision making from, if you remove punishment from the person who makes the decision, they will not be incentivized by the fact that they could be punished to make better decisions, something like that. So, one way to mess up a complex system is if you decouple and alienate the systems of incentives, right? This is something Thomas Sowell also talks about in Basic Economics. All of these guys, including Ryan Cohen, right? Ryan Cohen is interested, particularly, it seems to me, his interest in, let's say, in GameStop, in Bed Bath & Beyond, right? In, say, the Carl Icahn school of investing. Why he and Roaring Kitty, who also ascribes to the Carl Icahn school of activist inventing, right? The guy who coined the term activist inventing. That this idea, right? What you come in and do is you come in and basically dismantle this or reform a system of, right, pathological decision-making relationships, of misaligned incentives and rewards. And what Ryan Cohen's mission seems to be right now is to provide a renaissance to GameStop, this dying brick and mortar company, basically by removing this kind of I don't know, if we think about Wall Street as like administrative oversight, if we think about excessive shorting and this sort of parasitical structure that's been placed on top of the company in order to extract money not only out of the company but out of, you know, out of investors, right, out of people who invest in the company, in the same way that, say, you know, someone, you know, allegedly, you know, like Polyev, I mean, I've seen this one podcast with him, is interested in removing the over bureaucratization of the Canadian state, which extracts money via tax dollars from the Canadian people, in the same way that, say, you know, what maybe Musk is trying to do now with this Department of Government Efficiency, right? There's this idea of putting a common interest between a lot of these people in terms of trying to, as I said at the beginning of this diatribe, let's call it, to optimize the emergent properties, certain emergent properties of formal complex systems. And so I wouldn't be surprised if we saw, as a result of this, this comment right here. It wasn't under Polyev, it wasn't under Peterson, but I wouldn't be surprised if we saw Ryan Cohen maybe pop on to the Jordan Peterson podcast, because, you know, Peterson was super interested in the Make America, this, you know, people involved with Doge, for example. I don't know. We could see Cohen on something like that. We got that article today that dropped that kind of talked about him maybe doing some podcasts. I don't know. Maybe he's got something up his sleeve that might come through in some podcasts. We'll see. Right? Talk is cheap. It takes money to buy whiskey, something like that. Right? So I guess we'll stay the course. But wanted to maybe end on that note. But yeah, if you guys don't have any more questions, then yeah, we'll wrap up. We'll wrap up the stream there. So yeah, thanks very much, guys. This was another great session here. Good. Am I frozen? Can you hear me? All right. Well, I'm frozen. I do not know what the short percentage is, because they have modified that statistic such that it is no longer meaningful. Anyway, I guess I'll just be frozen. Probably my camera died. But in any case, thank you very much, everybody. Thank you very much for a wonderful stream once again. Have an excellent weekend. I like this question. We'll come back. We'll lead off. We'll lead off the next live stream with this one. Top 3 celebrities to invite to an escape room. But thanks very much, you guys. Good luck this weekend. Please enjoy your weekend. Enjoy your week. I'll look forward to seeing you guys on Monday. You can look forward to my Monday analytics. You can look forward to my Monday video. But thanks so much. Thanks as well. Thanks for your support. Thanks for your support over on X and here on the YouTube videos. So let's see what's coming up into January OPEX. So enjoy your weekend, everybody. We'll see you.